Hello, everyone. I'm Ted Oakley, managing partner here at Oxbow, and it is my great pleasure again to have one of the all-time sought-after speakers we've ever had, and one of our most watched speakers, Neil Howe, the great, I guess I would call demographer. Neil, is that what you would call yourself?
That's one of many things people call me.
Yeah. But Neil has written many books. We've talked about the fourth turning, which is sort of what we're talking about today. But the biggest question we get today from all investors is, hey, where are we going? What's going on here? What's the outcome of all of this over the next 5 or 10 years? And I couldn't have a better person to talk about it than Neil Howe. So Neil, welcome.
Great. Thank you, Ted. Thank you for having me. It's great to be back. And it's been a crazy time, right? It's almost as though people are still disoriented. We kind of took a step outside of the normal, right, with the pandemic and the response. And I will say this, if you had asked anyone back in March, you remember of 2020 when the markets were going south in a hurry, that in 354 trading days, we were going to double over the low, right? And with the fastest doubling time ever, certainly in the post-war era. And that not only that, but 18 months later, when we were doubling, our employment would still be 5% under where it was going into the pandemic. And we would still be having, 1,500, 2,000 deaths a day. I think they would have thrown you out of the room. I mean, doubling alone, they wouldn't have believed. But if you had added that, they would have said, that's absolutely impossible. That could not happen. But it happened. Not only that, but we just celebrated about a week ago the 40th anniversary of the great bond bull market, right? September 30th, 1981. The 10-year yield reached its all-time high, 15.84. And it's been down ever since. Sometimes kind of a rocky down, but it's been down ever since. And if you had said to people with this kind of, robust recovery, and the fact that the yields now are several percentage points below the CPI and are 90 basis points below what the bond investors themselves expect inflation to be over the next 10 years, right? That's the break even. That's the 10-year break even. They would have looked at you funny, right? What?
And Neil, that goes back to your great piece you wrote entitled "Why Nobody Knows Anything."
Yeah, why nobody knows anything, indeed. And I think the where people went wrong, and I will say too, this has thrown off people who rely on the old, a lot of the values metrics, right? So a lot of long-term investors rely on these things. These are things like Shiller's PE, Shiller's price earnings, or price to sales, or you remember the Buffett indicator, which is the S&P total market cap as a share of GDP. These things are off the charts, right? So you'd say they're screaming sell, but if you had sold over any time over the past, a year ago or 9 months ago, you would have been killed. So all of that raises the question, what went wrong with all the traditional metrics and what goes wrong with people's thinking? And my feeling is that it has to do with the regime change that's taking place. All of these values metrics and all of these ways of looking at the market were valid for a particular kind of regime. And the kind of regime we had in place until very recently is what I call the sort of the neoclassical, or neoliberal economic regime, which is basically the Fed buys and sells short-term public securities, right, to balance the recession cycle. That's all it does, and the federal budget is roughly balanced over the business cycle because the Congress knows that it can't rely on the Fed to balance, to bail it out, right? I mean, that's all the Fed is doing this marginal intervention at the short end of the curve. Over the past 2 years, and we started doing that actually with the GFC back in 2009, remember, with quantitative easing, But over the past 2 years, especially, we've gone full MMT, sort of the modern monetary theory, which is a very different kind of regime, which basically the Fed can buy any security at any duration, right? Any bond duration. They could even in extremis, go and buy equities. At one point that was being discussed, they could certainly buy junk bonds, high yield debt. They can buy anything, and they can buy in any amounts. And therefore, the federal government can now cut taxes or increase benefits freely without any regard to deficits because the Fed will monetize the excess, right? And so what that's led to is a scenario which never could have existed before. Enormous deficits, which basically no one really cares about because the Fed is basically just, buying up all the debt. So it disappears from the market. And I think I have a couple charts here to show some of the anomalies, right? We have one here on which I did recently on the average change in real GDP and disposable personal income over 6 quarters, starting with the first quarter that was impacted by the pandemic, right? And you can see here that in over the average of the 4 previous recessions, real GDP over 6 quarters went down 0.3% of GDP, right? 0.3% from that index, from that initial pre-recession quarter. And disposable personal income went up 1.5%, right? So people were getting kind of an extra kicker of maybe 1.8% over what GDP was producing. And that's sort of what we think of about balancing the business cycle. Take a look at this recession. Real GDP went down 2.8% and real disposable income went up 7.3%. So we've lived 10% and 10% better than basically our income, our what we're producing through GDP. And in fact, we're living 7% better than if we had no recession at all in terms of real disposable income. And I actually have another chart just showing the trend in real disposable. Just look at how it spikes here. And this is basically all the extra income that Americans have been getting. So, in that kind of situation, all of this sort of makes sense, right? Particularly when the Fed is buying down all the yields at such a low rate at all risk, at all risks, right? At all credit risk, and promising to keep them down indefinitely. It basically tells investors, buy anything and you'll make money. It really doesn't matter. Borrow to buy. And the amazing thing to me is that corporate buybacks, were almost fully recovered in the first quarter of 2021, even while debts were still peaking from the pandemic and GDP was still underwater. I believe in this quarter that we're in right now, we're going to set a record for buybacks. Now, that's all these corporations going out and leveraging themselves even more, right, to buy back their own shares. Here's my point. In this kind of economy, where people are begged to borrow, the S&P 500 has no relationship anymore to underlying economic performance, right? And that's my point. Now, I know the question you're going to ask, what's the end game? Where does this go? I think that's what people want to know. Where does it go? And I do believe it has an end game. And I believe actually that the values rules, these values valuation rules of thumb that people have trusted, it's not that they're invalid, but as you go into a regime change, they work indirectly and with a delay. We have to get used to the new regime before they come back, right? And they will come back. The way they come back, Ted, is inflation and inflation expectations. There's no question about that in my mind. And we see it happening, right? That's what's going up right now. That's what's beginning to spook the market. We already see it beginning, right? We sort of see it a little bit, the inflection curve. And as I see it, when this fully becomes operative, it's going to be very punishing, right? Because the first thing that's going to happen is, and even modern monetary theorists agree with this, inflation does put an end to the largesse, right? Even the MMT people agree. Yes, I mean, when there is inflation, you've got to suddenly, start contracting, right? All of that monetary easing becomes quantitative easing becomes quantitative tightening. So we already see that's going to go into effect soon. And I think people are already nervous that the Fed is sort of delaying that. That's going to go into effect. Then, of course, the Fed is going to be tightening rates at the short end. And then, of course, meanwhile, the rates will be rising at the long end. And ultimately, of course, the Fed is going to have to get ahead of inflation expectations. They can't constantly be lagging behind. They'll have to get ahead of inflation expectations. That's going to raise the discount rates on all of the earnings that people are expecting. That alone is going to bring down, right, equity markets. In addition, because suddenly no one's expecting the Fed to backdrop all of the high risk credit markets, right? All of the debt pyramids will start collapsing, right? So at the high risk, high beta, all of the classes of stock, you talk about style elements in stock that have benefited so much. I mean, the trashier it is, the more it's risen. And all of that's going to come down first. That's like the whip end. That's going to come down first. And so you're going to get that happening as well, because suddenly the Fed guarantees the Fed is basically saying now, no more Greenspan put, no more Bernanke put, no more Yellen put, right? It's no longer there. We can't do it now because inflation finally is back on the agenda. So that's number two, right? You're going to have this increasing deleveraging going on even while the discount rate is going up. And the final killer is this. And I've talked a lot about this. I've had presentations, long presentations actually earlier this year. The final killer is what's this going to do to fiscal policy? Because never before in American history have fiscal projections depended so utterly upon very low interest rate projections, right? We're projecting interest rates to stay under the nominal growth rate of GDP for the next 15, 16 years. Are you kidding? I mean, that means that we can freely have huge budget deficits, add to the national debt, have the debt go up as a share of GDP, and yet the debt service payment actually decline, right? Because the interest rate is actually being outraced by the growth of GDP. This is crazy. And once those long-term projections are revised, as current inflation begins to go up, you begin to add 100, 150, 200 basis points to those long-term projections. Suddenly, the growth rate, you're getting the growth in debt per GDP that now still seems kind of unaffordable, unsustainable, which is something like, it's going to go up to maybe 150% of GDP by the mid-2030s. That's going to suddenly go to 200, 250, 300. It's going to be just runaway, right? I mean, at some point, it runs away. And at that point, Congress is going to have to tighten at the same time that the Fed is tightening, at the same time that all this high yield debt is beginning to contract. So that this time, the federal budget will be unable to balance the tightening. That's my point. And they will have to do that because simultaneously you get a run on the dollar, right? Everyone who's invested abroad in our treasuries are going to be in wonder with these projections, will they ever get paid back? So you're going to have and I'm going to come back to that in a second. So all of these things is going to do something that was not done back in 1981. You remember when Volcker came in, right, to put an end to inflation. And Reagan came in around the same, Volcker came in first, and then Reagan was elected. Reagan came in. Reagan had a very interesting plan. He said to Chairman Volcker, yeah, I totally agree. Stop the growth in the money supply, tighten, do whatever you have to do, make things miserable for a while. This is going to be a kind of cold turkey. We're gonna emerge from inflation. It's not going to take us a decade or two. We're going to do it in a couple of years. And he did it. But meanwhile, Reagan ran huge deficits to compensate. So yes, we did go into a bad recession in 1982, 83. I remember. I mean, that was, you probably remember too. That was not a pleasant recession, but we were able to compensate through large federal deficit spending. This is my fear, Ted. In this coming crash, the federal government won't be able to compensate anymore because simultaneously they're going to be having to deal with these deficit projection problems. We didn't face that. Remember that in 1981, federal debt, publicly held debt as a share of GDP, was down to its record low. You know, we inherited a lot of debt from World War II, but then through a lot of real growth and then through inflation, we got rid of most of it, particularly in the 70s through inflation, right? So we were down to like 32% of GDP or 30% of GDP debt. Well, that seemed pretty reasonable. So Reagan could do that. Not now. We're back up at 103, 104. We're back up to where we were at the end of World War II already. And we haven't fought a war, Ted.
I tell people that because that time between 1944 and 1980, if you just looked at the numbers on it, they basically went all the way from where we were, 100 and something percent of GDP
Right.
government, all the way down to what you're talking about, 30, 32. And I try to tell people that today. I say it's a different game today. It's not the same.
There are, a limited number of things you can do to get out from under this. It would be great if we had a big productivity boost. Productivity can hide 1,000 sins. If you suddenly have the economy much more productive, but of course that would take a miracle. And it's not as though we borrowed all this money to invest in our productive capacity, right? We haven't. To some extent, that's the object of the original infrastructure package, which awaits, which both the Senate and the House have passed. But thus far, that isn't what we're doing, right? And these are enormous deficits. Remember that we started, by the way, this started with Trump. This did not start with Biden. We went into the recession under President Trump with a deficit of nearly 5% of GDP. That is a record for a peacetime, non-recessionary deficit, right? I mean, we've never done that high a deficit before. Unrelated, we were a full employment economy in 2019, right? And then we moved up to 12.5% of GDP in each of the next 2 years, right? So that was the extra kicker. That was the extra 7.5%. That translated into a 10% rise per year in real disposable personal income. And that's how you got that miracle effect. And that was the miracle effect that hit the markets. And that could not have happened under the old regime, Ted, but it happened under this new regime, right? So that's what we're dealing with. Now, how are we going to get out of this? Again, productivity, I don't think is going to get us out. It would help if Americans suddenly in their private lives saved to compensate for the taxes inevitably that they're going to have to pay, where the benefits they're not going to receive. But I don't think that's going to happen either. I think Americans today I think they agree with Dick Cheney, right? Reagan proved that deficits don't matter. Remember that famous quote. So I don't think they're going to do that. I think if even Republicans believe that, I don't think that's going to happen. So I think we're down to inflation. And inflation will be used by the Fed. Now, this is the difference. This is the difference between Volcker and what Jerome Powell or any of his replacement is likely to do. They're going to allow a lot of inflation, just enough that it doesn't get out of hand. They can't allow it to accelerate. Obviously, that would just cause panic around the world. The dollar would fall, and they can't do that. But I think they will allow a fair degree of inflation, a lot more inflation than we've experienced in the past, maybe even slightly accelerating over time, so long as it's controlled. And the reason is this: it solves a whole bunch of problems. Inflation is not it's not a problem in a way, it's a solution. Think about it. First of all, it allows the economy to run hot because you keep fooling people that they're getting more income. It's kind of what we did back in the 60s and 70s, what we did during World War II. You constantly give people higher nominal wages. You can run the economy hotter that way. The second thing it does is it pushes inequality down, right? You think about it, you're basically taking from creditors and you're giving to debtors. And finally, it pulls the federal debt as a share of GDP down effortlessly, right? Because you're inflating your way out of all that debt, right? So you're basically defrauding all your current creditors, if you want it that way. Oh, and there's one more thing, Ted, I didn't mention. A third of the people who hold federal debt are foreign entities. They're abroad. They're sovereign wealth funds. They're foreign central banks. So here's another reason: America first. I mean, think about it. We'll defraud non-Americans. So all of those reasons are reasons why we will do it. And here's the last thing: that we've done this before, and it started actually 40 years before 1981, 41 years before, in 1940. And this is what I pointed out in that piece. In December of 1940, American bond yields didn't reach a high. They reached their all-time low before the GFC, 1.95%. That was comfortably above inflation. You remember 1940, we're still coming out of the 1937 recession. We were still in the backwash of the Great Depression. And everyone thought that was a great yield, 1.95%. Guess what happened right after that? About 2 or 3 months after that, suddenly Americans, everyone, Congress, all got panicked over the fall of France and the Battle of Britain. And suddenly FDR wanted to be an arsenal for democracy. So we started running huge deficits, massive defense spending. And then by the December of 1941, obviously we went to war. I mean, that's when we declared war. That was Pearl Harbor. And for the next 17 years, we ran a massively hot economy. And Treasury, with Fed compliance, kept the yield at 2.5%. So there was massive financial repression. And guess what? All those bondholders lost all of that real value. We went through excruciatingly negative real returns on federal debt. Now, the result was that began a period of roughly 30, 40 years of decreasing inequality, right? That was the whole American high. Decreasing inequality, relatively hot running economy, increasing regulatory edifice for economy. And here's kind of what I'm saying. This is maybe my final remark on it, is that since 1980, we've assumed that the only direction the economy can take is toward, lower rates, lower inflation, a cooler running economy, higher inequality, and deregulation. And we have to remember the previous 40 years, we went in exactly the opposite direction on all those trends. And I believe that this could be a moment when we're beginning to veer again in the other way. In other words, this is a new regime, a new long-term regime, possibly.
There's no telling how many people in this business have never seen any sort of inflation. I have, unfortunately, fortunately, I should say, I'm not old enough where I've seen it, but they won't know how to deal with it. And you've got a couple of slides here that talk about sort of when the rollover is, that there's, you sort of hit the wall somewhere out there at 12, 15 years. And what does that look like? Do we go back to where we were before, sort of people look at valuations instead of, those insane stuff?
This is a great point. And if, I don't know if you can bear with me just for a few charts, because I think we have a few here. We can just go through them quickly. I think what you see here is that you have to see this against a backdrop, totally regardless of this crisis. We were already reaching a huge declining capacity as an economy due to purely demographic reasons. And I think I wanted to point out a few of those. I mean, for instance, if you look here at this, this is the latest CBO projection, right, going up to 2051. And one of the things people don't realize is this huge decline in expected GDP growth. And I'm not sure people are focused on, in other words, investors fully focused on that. We had up through 2020 an average of 3.2% real GDP growth. The CBO is now expecting 1.6, half of that over the next 30 years. And so people are saying, oh, well, who knows? That's the CBO. They're pulling this number at us somewhere, right? No, they're not pulling it at us somewhere. They're pulling it at something we absolutely know, and that is the complete cessation of growth in our working age population, right? And that is because suddenly the boomers are retiring, and the new generation coming after them are much reduced in number. So this is the next chart we show here. This is breaking it down into productivity growth and labor force growth. And you can see here, labor force growth, which 1950 to 2020 was 1.3% per year and was huge, right, during the 1970s. What's interesting, when we had all that stagflation, Ted, we had boomers coming on stream. So we had an enormously expanding economy. These new young people coming on board, right? So it should have been a great time for GDP growth. Of course, productivity growth slowed to almost nothing. But that's what boomers brought to the table. Anyway, further on, you can see here, look at this. You get no contribution from labor force growth. Productivity growth, CBO, is actually, in my opinion, actually a little bit on the optimistic side. They're expecting we can still have actually healthier productivity growth than we've had since the GFC, definitely, right? And to show this on this next chart, actually on the next chart, this is 7. This is U.S. working age growth by component rate. And we just divide it between, natural increase, that is to say people being born in the United States minus exits, people, entering who are native born versus immigration. And you can see how both immigration and natural increase has fallen, particularly natural increase, and you can see how low it is. On the next chart, we'll go through these, but on the next chart, you can see the CBO differentiating total GDP growth into, again, what we just did on the other chart, potential labor force growth, potential labor force productivity versus, again, employment growth. And you can see that their productivity increases are actually slightly larger than they were in the 2008 to 2020 era. That's my point. These are not productivity pessimists at the CBO. That's what I want to emphasize. That's what I usually hear. The CBO, they just think, we're non-productive. Then the final killer is this. This is chart 9. This is the total deficits now projected under these optimistic interest rate assumptions and a number of other optimistic assumptions, I must say. We're not going to come anywhere near, not within a prayer of budget balance, even under our current projections. And you can see how it's going to go south from there. And then finally, this is chart 10. These are the official projections of federal debt held by the public as a share of GDP, rising to 202% of GDP by 2051 under these unbelievably optimistic interest rate assumptions. And you can see, though, how in the 2020s, the debt to GDP level is stable, despite the fact we're running these huge deficits. That's what I was talking about before, right? You assume low enough interest rates, and you can run big deficits and experience no growth in GDP. And then finally, on chart 11 here, you see the real interest rate assumptions. 2038, before the projected real rate of growth of the economy, before the projected real rate of interest will exceed the real GDP growth rate. That is what? 17 years of free borrowing, right? Where your borrowing it can be borrowed at interest, which is less than economic growth. I mean, that's just a ticket to ride. And I have another chart here on how a very slight assumption of greater interest rates would add to the deficit in the out years. And then finally, because I promised I was going to get back to this, our U.S. and net international investment position. And, it's interesting. If you look at the secret to how we could have such low interest rates, in the post-GFC period, the reason was we were borrowing massively from abroad, right? We did that before the GFC in the early 2000s. We did that after the GFC. Everyone was lending to the United States. And you can see where we are now. It's really beginning to go south. And the point is, at some point, people are going to stop. They're going to say, wait a second, we just don't believe the United States anymore, that they'll ever be able to pay us back. We're going to start slowing down, right? And when that happens, You think the dollar, we've had some periods of down dollar, obviously, over the past 18 months, right? As inflation in the US has sort of warmed back up again. This would be something much bigger than that. This would actually take us back again more to the 70s, which we remember that was a time of periodic dollar panic. And then finally, of course, Nixon, as I recall, took us off the gold standard. And when I talked earlier about financial repression going into effect, I'm really wondering how all these Gen Xers are going to respond who have never had any inkling of what that means. I mean, why can't I invest my money anywhere? Are you kidding? What are you? Isn't this America?
Well, they've never had anything bad happen. I say that all in all. They've never hit the wall.
Well, they've never hit the wall. They've hit the wall personally. They're very accustomed to personal challenges, I would say, but they're completely unused to national social urgency, right? Where the entire country, the entire society has to decide on something together and actually decide on distributing not benefits, but distributing pain. And I do say that's going to be the interesting situation Congress is in. You think the political polarization is bad now, when the only things we're distributing is, who gets tax cuts and who gets additional benefits. Wait until we're distributing who gets taxed more and who's, everything is bad, right? Who gets fewer benefits, who gets taxed more because we have to narrow the deficit. That's when it gets really stormy, right? And at some point, of course, what you'll have to do is just delegate someone in charge.
So I'm sitting here as some naive investor, so to speak, and I'm listening to you, and I'm thinking about the next 15 years, let's say, 12 to 15 years. And what I would probably take away, you tell me this if this is not true, is that it's going to be a rougher time for financial assets. It's going to be certainly a rougher time for the bonds. And you'd probably need something to own that would give you some sort of relief against inflation, those types of things. Am I hearing you right?
Yes, I would say, I've been recommending now for a while, stay away from long-term commitments to anything denominated nominally, right? In nominal amounts. I don't care what it is, but if the return is nominal, right? Like any kind of credit instrument and so on, stay away from that. Those are going to be killed. And the riskier it is, the more it's going to be killed, right?
And for the audience out there, what he's talking about is don't lock into something that does not have an inflationary capacity to it.
Exactly. Now tips is fine, right? I mean, anything that inflation adjusted treasury securities, the tips, that's okay. If you really want something that's risk free and does adjust to inflation. I would also say you want to invest in things also that don't rely upon huge momentum in the market. We've talked a little bit about indexing funds, right? And this could also be a moment of truth for that kind of investing. And you can see, with Facebook in the last couple of weeks, what goes up can come down. I've had a somewhat dark view of the trend in indexing, right? In equity markets around the world. Not only do I think it encourages crowding behavior, which, and finally, if the crowding is strong enough, no one bets against it, right? So it just goes full tilt until it goes over the cliff. I think not only does it do that, I also think it has very deleterious long-term consequences for the economy because I think it's inherently anti-competitive. Remember, the whole idea of indexing investing is that all investors own the entire market. So I often ask people to stop and think about that. What happens when the auto industry realizes it's all owned by the same people? Think about that. How much of they can compete against each other? Not at all. And we see so many measures of increasing market concentration in industry by industry, and the increasing slowdown of business dynamism in the American economy coincide with the rise of index funds. This is now a serious problem, according to a rising school of economists. By the way, a lot of them are the new generation coming out of all places, Ted, University of Chicago. So imagine these are the new anti-monopolists coming out of University of Chicago, and they are saying this was really a bad idea because what happens is executive boards and CEOs suddenly realize that the only one who really cares about their biggest vote, right? And by the way, they all vote by proxy. All these ETFs, they always vote, right? The individual investor often doesn't. So their regulations require them to vote. And guess how they vote? Whatever the executives want to do is fine, right? So, and the executives go along to get along, and what they generally do is work to prevent new competitors, as you would. I mean, if you represent all the same people, the only person you're competing against is either workers, consumers, or new arrivals to the industry.
Well, it'll be interesting to
Anyway,
see.
I don't think that's healthy, but
Yeah.
anyway.
What you're talking about, too, it'll be interesting to see when you get into what you're discussing over the next 10 to 15 years, you will get a change the other way when everybody that owns becomes everybody that sells.
Yeah, well, that's the herding. Because herding can go both ways, right? You can have herding on the sell and the buy side, but just as fast you can have herding on the sell side, right? And that's the danger. Yeah, so it's going to be an interesting time. And now of course you have no fee brokerages and all these new online platforms. So you're bringing in more people than ever to participate in this herding behavior. It's going to be fascinating to see, Ted, how this finally plays out.
Well, and we didn't talk about, and we don't have time, but we didn't talk about cryptos and NFTs and every other speculative thing that you can buy in every SPAC out there. But I literally, we could talk to you, Neil, for 3 or 4 hours. You have the most information of anybody that I know about what goes on in demographics. So I want to thank you for being with us today. I think everybody will find that interesting, and I would recommend to everybody out there to go look at Neil's books, and particularly look at The Fourth Turning. It discusses a lot of things that go on during this period, and also any of the other books he's written, and a new book he'll have coming out in 2022. Am I right, Neil?
Yes, it doesn't yet have a name quite, but we're under contract with Simon & Schuster, and we're all I have to do is write it. So I'm under the gun more than ever, Ted.
All right, Neil. Well, listen, thanks so much. And hey, we look forward to seeing you again soon. Thank you.
Great. Thank you, Ted.